The automotive world was abuzz with news in late 2024. The industry was on the edge of its seat, anticipating a monumental shift that could redefine the landscape of car manufacturing and sales. Two Japanese giants, Nissan and Honda, were in talks to merge. This potential merger was seen as a strategic move to combine their strengths and address the challenges of a rapidly evolving market. This mega deal, worth an estimated $60 billion, had the potential to reshape the global car industry. Analysts predicted that the combined entity could dominate the market, leveraging economies of scale and a broader product lineup. It promised to create a powerhouse, combining Nissan's manufacturing scale with Honda's reputation for innovation. The synergy was expected to lead to groundbreaking advancements in electric vehicles and autonomous driving technologies. But, like many ambitious plans, it was not meant to be. Despite the initial excitement and optimism, the negotiations hit several roadblocks. The merger talks collapsed in early 2025, leaving many investors scratching their heads. The sudden breakdown of discussions sent shockwaves through the industry, causing stock prices to fluctuate wildly. What went wrong? Why did these two seemingly compatible companies fail to reach an agreement? The reasons were multifaceted and complex. The answers lie in a complex web of corporate pride, differing visions, and external pressures. Both companies had strong corporate cultures and leadership styles that clashed during the negotiation process. Understanding these factors is crucial for investors who want to navigate the ever-changing landscape of the auto industry. The failed merger serves as a reminder of the challenges inherent in large-scale corporate deals and the importance of aligning strategic goals and corporate cultures. On paper, the Nissan-Honda merger made a lot of sense. Both companies had storied histories and a strong presence in the automotive world. By combining their strengths, they aimed to create a powerhouse capable of leading the industry into the future. The global auto industry was facing major disruptions. Traditional car makers were being challenged by new entrants and rapidly changing consumer preferences. The rise of electric vehicles, the push for autonomous driving technology, and the growing popularity of ride-sharing services were all reshaping the landscape. Electric vehicles, self-driving technology, and ride-sharing services were forcing car makers to adapt quickly or risk being left behind. The pressure to innovate was immense, and only those who could keep up with the pace of change would survive. Both Nissan and Honda were facing their own unique challenges. Nissan, once a pioneer in electric vehicles with the Leaf, had fallen behind in the race for technological supremacy. The company was also grappling with internal turmoil and declining sales. Nissan's early success with the Leaf had given it a head start, but complacency and missteps had eroded its lead. The company was now struggling to catch up with competitors who had invested more aggressively in new technologies. The company was also grappling with internal turmoil and declining sales. Leadership changes, strategic misalignments, and a series of scandals had taken their toll, leaving Nissan in a precarious position. Honda, known for its fuel-efficient engines and reliable cars, was also feeling the pressure to innovate. The company had built a reputation for quality and dependability, but the shift towards electric vehicles and autonomous driving required a different set of skills and investments. The company was lagging in the electric vehicle market and needed to invest heavily in new technologies. Honda's engineers were hard at work developing the next generation of electric and autonomous vehicles, but the road ahead was long and fraught with challenges. By joining forces, Nissan and Honda could have pooled their resources, shared development costs, and streamlined their operations. The merger promised to bring together the best of both worlds, combining Nissan's experience in electric vehicles with Honda's engineering prowess. A merger would have created a behemoth with the scale to compete with giants like Toyota and Volkswagen. The combined entity would have had the resources to invest in cutting-edge technologies and the market presence to challenge the industry's biggest players. Investors were initially enthusiastic, driving up the stock prices of both companies. The potential for increased profits and market share was alluring, and many believed that the merger would create a stronger, more competitive entity. The potential for increased profits and market share was alluring. Analysts predicted that the combined company could achieve significant cost savings and operational efficiencies, boosting its bottom line and enhancing its competitive position. However, beneath the surface, cracks were already beginning to show. Cultural differences, conflicting priorities, and integration challenges threatened to derail the merger. The road to a stronger future was proving to be more complicated than anyone had anticipated. One of the biggest stumbling blocks in the merger talks was Nissan's reluctance to cede control. The negotiations were intense, with both sides presenting their visions for the future. Nissan's executives were particularly wary of losing their autonomy. Once a proud leader in the Japanese auto industry, Nissan had struggled in recent years. The company, which had been a beacon of innovation and reliability, found itself grappling with declining sales and a tarnished reputation. The company was still reeling from the Carlos Ghosn scandal, which had exposed deep-seated problems with its corporate culture. The scandal not only shook the company to its core, but also eroded trust among its stakeholders and employees. The proposed merger was seen by some within Nissan as a rescue mission by Honda. While Honda's stability and success were appealing, the idea of being rescued was hard to accept for many at Nissan. This was a bitter pill to swallow for a company that had once been a symbol of Japanese industrial might. Nissan's history was rich with achievements, and the thought of merging felt like an admission of failure to some. There was a sense that Nissan's legacy and independence were at stake. The fear of losing their identity and becoming just another division under Honda's umbrella was palpable. This resistance to change, fueled by a mix of pride and fear, ultimately proved to be a major obstacle in the negotiations. The boardroom was filled with tension as executives debated the future, each side holding firm to their beliefs. The question remained, could Nissan overcome its pride to secure a stable future, or would it let the opportunity slip away? Honda approached the merger from a position of relative strength. The company had weathered the industry storms better than Nissan and was eager to expand its global reach. However, Honda's proposal was not a simple merger of equals. The plan called for Nissan to become a subsidiary of Honda, with Honda executives taking key leadership roles in the combined entity. While this structure made sense from a financial perspective, it was seen as unacceptable by many in the Nissan camp. They argued that it would reduce Nissan to a mere division of Honda, stripping it of its identity and decision-making power. This fundamental disagreement over the structure of the merger further deepened the divide between the two companies. Section 5. Job cuts and factory closures. The human cost of consolidation. Mergers, especially in mature industries like automobile manufacturing, often involve streamlining operations to reduce costs and improve efficiency. This often translates into job cuts and factory closures, a reality that both Nissan and Honda acknowledged during the merger talks. However, the two companies couldn't agree on the scale and distribution of these cuts. Nissan, with its larger workforce and more extensive manufacturing footprint, feared bearing the brunt of the downsizing. There were concerns that Honda would prioritize its own factories and employees, leaving Nissan workers disproportionately affected. The sensitive nature of these issues made it difficult to find common ground. Section 6. Renault's shadow. A complicating factor, adding another layer of complexity to the situation, was Nissan's existing alliance with French automaker Renault. Renault held a significant stake in Nissan, giving it considerable influence over the Japanese company's strategic decisions. Renault was reportedly wary of the merger with Honda. The French automaker feared that a combined Nissan-Honda entity would be a formidable competitor, potentially threatening Renault's own market share. Renault's concerns added another layer of scrutiny to the deal, making it even harder for Nissan and Honda to reach an agreement. Section 7. Moving forward, Nissan's uncertain future. The collapse of the merger talks leaves Nissan at a crossroads. The company is still facing the same challenges that made the merger seem like a viable option in the first place. Nissan needs to invest heavily in electric vehicle technology, revitalize its product lineup, and address its internal problems. The failed merger is a setback, but it also presents an opportunity for Nissan to chart its own course. The company needs to articulate a clear vision for the future and convince investors that it can compete in the rapidly evolving auto industry. Whether Nissan can successfully navigate these challenges remains to be seen. Section 8. Honda's next move. Staying the course or seeking new partnerships. Honda emerges from the failed merger in a relatively stronger position. The company is financially sound and has a solid reputation for quality and reliability. However, Honda still needs to accelerate its efforts in the electric vehicle market and adapt to the changing dynamics of the industry. The failed merger with Nissan may prompt Honda to explore other partnerships or acquisitions. The company could also choose to go it alone, leveraging its strengths to carve out a larger share of the global auto market. Honda's next move will be closely watched by investors and industry analysts alike. Section 9. A changing industry. What the failed merger means for investors. The collapse of the Nissan-Honda merger is a stark reminder that even the most logical mergers can fall apart. For investors, it highlights the importance of looking beyond the initial hype and carefully considering the complexities of such deals. The automotive industry is in a period of rapid transformation. Investors need to be selective and focus on companies that are adapting to the new realities of electric vehicles, autonomous driving, and changing consumer preferences. The failed Nissan-Honda merger is a valuable case study in the challenges and opportunities that lie